I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview. Hi, everybody. Nate Lind here. I've got Manny Torti from the Torti FLANAGAN law firm. We're going to talk about LOIs, letters of intent. We're going to go into it in detail. We're going to go through the standard template that we have here at Website Closers. Manny's had a chance to go through it. He is independent from Website Closers. Our corporate counsel has put this one together, and we've used it a whole bunch. And I have seen some deals get held up on this, and thought it would be appropriate for us to have somebody from the legal world take us through it. Manny, why don't you fill us in a little bit about yourself to get us up to speed on how you got here, and then let's jump right into this LOI.
Okay. I've been representing a small to medium-sized, generally founder-controlled businesses for over 30 years. And we have a small corporate boutique practice focusing on entrepreneurs and their businesses. And through the grapevine, I met Nate, and we hit it off. And as he said, I'm totally independent from his business, and I'm trying to give an independent review of this and try to give a quick overview of it from a legal point of view.
My goal is for folks to not be so damn scared about putting in an LOI on a business. It's not binding. At the same time, we don't want to waste time. Like, don't start throwing LOIs out there on businesses you don't have any interest in closing. But we've got a template here. Provided to any of the buyers that are interested in the businesses that we have. So I want to go through this and be thorough about it. And Manny's been kind enough to highlight some stuff, and we're going to pull it right up here on screen. So without further ado, I'm going to share my screen. I'm going to pull this bad boy up. Manny, walk us through this bad boy.
Okay. I want to start off by looking at where you are in the process once you get to the letter of intent. Once you get to the letter of intent, you've already had some very preliminary discussions between the buyer and the seller. You've probably signed a non-disclosure agreement, which in essence basically says that any information that the buyer would glean from discussions or evaluation of materials with the seller, they would keep confidential. They would only evaluate them for their own purposes of evaluating the business. And so that being done, the next step would be a letter of intent. The letter of intent is a general statement of intent. So it's a general intent, and it doesn't get into the granularity of all the details that you would get once you get into the next phase, which would be negotiating a definitive asset purchase agreement or stock purchase agreement, and going through a detailed due diligence where you'd look at the details of the financials, the assets, etc. So that's where we are. We're at the letter of intent phase. And also it is, in fact, as Nate mentioned, it's a non-binding document, but it's very important to get it right to the extent that you can get as much information as possible, because what often happens is when you have a general statement of intent and then you get into negotiating with the other party, and the more you vary or deviate from the LOI, it could cause some ruffled feathers, if you will. So you want to get as much information as you can put in to set forth your general intent. So with that being said, I could walk through each paragraph as we go through this, and I'll try not to be too wonky about it, but give you an overview.
No, that's great. I figure I'll jump in for a moment to
Sure.
validate what you just said. Absolutely. At this stage, we've already talked. If you're a buyer, we've already talked with the seller. If you're a seller, you've talked with the buyer. Now you're seeing that interest written down. Buyer serious. At the same time, this is not binding, so they can back out. They're going to go through due diligence, and they're going to verify what they understand to be factual about the business, and start dotting I's and crossing T's. But at this stage, this is when we start to get serious, and we're starting to hone in. We don't have multiple letter of intent signed and going with multiple parties at the same time. We're working through the process with one buyer at a time. And as a seller, you'll have an opportunity. If your business has attracted lots of attention, you'll see several letters of intent. And you'll have a chance to pick the one that you think is the strongest offer. At this point too, we've also validated and vetted the strategic fit of the buyer and the seller, the financial capability of the buyer to be able to finance the deal, or their liquid, their liquidity to be able to purchase the business. And then also, we're looking at, kind of the whole package, so to speak, as to how it's all related to the business. The buyer's experience, are they a first-time buyer? Have they bought multiple businesses? So all of that has been evaluated, and now we're looking at the LOI. Manny, please take us in.
In the first paragraph, I just want to point out, you notice that there, in the very first yellow there's identification of a particular company that's the purchaser. And it's very important because in all of these agreements, whenever you look at a legal document, defined terms are critical. So whenever you have a capitalized term for purchaser, that would be as though you could cut and paste the name of that company throughout the document, and that's the meaning. And it's very important because you can often refer to a paragraph that might have a purchaser in general, not capitalized, and that has a totally different meaning. And that's just a contract interpretation that's very important to know. And so you're going to have the purchaser, and in this case, it's a company, not an individual. Some companies would want an individual to be signing on if it's a small company, or perhaps they want the individual entrepreneur to basically put their own personal name because they're going to be getting some access and information personally, and they want to bind them. But here, in this case, is for their company, and they're going to enter into this letter of intent, and it's very clear that they're going to set up an acquisition company for the purpose of accepting and receiving all of the assets from the target company that's being purchased. And then we go further on to have the acquisition of the assets by the acquiring company. Once that whole process of the acquisition is now defined as a transaction. So whenever you see transaction capitalized, it means the acquisition of the company by the acquisition company, nobody else. And that's defined, that's the defined term. And then the consummation of that transaction obviously would be called the closing. Now, the parties are going to negotiate a purchase agreement, and they're going to pay a certain amount of money, the purchase price, and that's defined. But then it gets into, as more fully described in Section 2. So many of these agreements, you really have to jump from one place to the other. So whenever you see, here we have the total purchase price, but how that's going to be paid out, the specific method of paying that total is going to be defined under 2.1. Now, this part is, you're going to have no liabilities of any kind of going to be assumed by the acquisition company. In certain circumstances, there might, it might be necessary to change the structure of the transaction, let's say from an asset to a stock purchase, and the people involved think it might be in their best interest. And we're basically saying that that's really not going to change the deal that much. But in any case, there are going to be no liabilities that are going to be assumed, and you're being very clear that you're going to escrow a certain part of the purchase price in case there's claims that are not discovered post-closing. And that can happen. You could have a vendor that comes out of the woodwork that you don't find. You could have an employee claim that just doesn't come up in due diligence. So you have an escrow for a period of time, 5-10%, if you will, of the purchase price for, say, for 1 year period. But that's clear. So when that comes up during the negotiation of the asset purchase agreement, one side's not going to say you're changing the deal radically. This is beyond your general intent.
Yeah,
so,
let me pipe in for a second. I've got a couple of examples where that's been an issue. So sometimes, sellers will take a look at this and they'll see what the total price is, consideration. They're trying to figure out what's the cash amount they're getting at the closing. Just remember the escrow there. That's protection for the buyer, making sure there's not, skeletons in the closet, ghosts in the closet, sort of stuff for the business. And that's something to be considered. If you're on the sell side, that's something that's very common. Many transactions, I'd say the majority of the transactions have something escrowed, especially the larger ones. Anything over $1 million, $5 million for sure, over $10 million, absolutely, you've got escrow in there.
That's great. Next thing under Section 1, you're going to have a purchase agreement, and it's going to be defined as the finalization of an asset purchase agreement, defining the transaction. And it's going to include the following terms and conditions. But there's another caveat, which is a safety valve, which is that it all has to be mutually agreed to. So now you have a non-binding letter of intent of your general statement of intent, and it all has to be by mutual agreement. So it's pretty safe to enter into these, but obviously, as Nate indicated, you don't want to do it casually because they're cumbersome processes to get involved with generally because you're, tying up another business and other people's time, etc. But you have a safety valve for both sides.
Absolutely.
The assets purchased, and this is extensive. I'm not going to go into the details, and this is a very extensive asset purchase list. But as extensive as that is, there could still be assets that are missing that could cause a problem. We just did an asset purchase this summer, and we're representing the seller, and it was a very complicated deal. And my client basically raised an issue at the very last minute. Is a deal breaker that they wanted all of the contact management data in the database of the company. And the company was saying, well, wait a minute, we have a non-compete. You can't go off and you can't have this data. And they're saying, no, we have a lot of friends and we host these big parties and we invite everybody to our parties and we want them to, all of these people, there's 10,000 people in this contact database. And they said, oh no, we have Christmas parties, or if one of my kids wants to network to find a job, it's critical. And that was unbelievable. So, that really wasn't part of the deal. So we worked out some deals saying, identify who's on your list and just go in and take out the personal contacts. Another deal we had, the business was being sold, and apparently there was some artwork that was involved. It didn't have a lot of value other than sentimental value. And at the very end, they said, well, what about the paintings? Well, but, now we're going to have to go and put things on the walls. Like, that's a hassle. No, we want the paintings. So they left it for a period of time and migrated. It just became a big deal. They were not, these were not works of art in terms of like expensive works of art, but it was inconvenient for the buyer to then discover that they're going to have to deal with that. They were just trying to get the business up and running, but it should have been identified up front. I throw that out there.
Yep. No, it's a good example. Be diligent about this. Here in the assets is where you've got an opportunity to list out stuff. We put a whole bunch of things in here. You've got, domain names, you've got accounts. We saw a lot of Amazon businesses. So Amazon accounts, any other marketplace accounts. It's website traffic, analytics, software and accounts, graphics, content, database. Like, it's the stuff that would be the meat and potatoes of an e-commerce or an online based business. So this is meant to be edited. As the buyer, you have to be sophisticated enough to understand what assets in the business are interesting to you and list them in here.
And now we have total consideration. Now this is a total purchase price, and the purchase price is defined in dollars. You always write it out in case there's a typo. Obviously, you write it out, you print it out in words, and then you write in the number. And that will be for full ownership. And then the guaranteed funds are described in as any adjustments in 2.3. But the guaranteed funds shall be paid at the closing. So you're going to have an escrow amount that's in escrow. You have the down payment. You have any bank financing as applicable, and you'll have a promissory note if applicable. And then earn out could be in the event that there's an earn out based performance bonus, if you will. I don't see those that often, but I don't know, Nate, you might see those on a more frequent.
Yeah, I want to talk about that here. So for under $5 million businesses, you need to have had a conversation with the broker before you start messing around with this. And the broker should know to be able to, and then should have vetted you. You should not have gotten to an LOI if you're planning to do, let's say, 50% or more of bank financing. If you're getting to 60% financing, 70%, 80%, you may have a serious issue, and you may have just wasted a ton of time because the sellers know long in advance as to what they'll accept here. Most sellers want 100% down payment. Boom. That's what they want. Most buyers want 100% bank financing. That's what they want. So you need to have a conversation with the broker and find out what's the seller expecting. I can share that most of the website closers deals, it's less than half is going to be in some kind of.
I'm not. I'm on another meeting.
I'm going to put you on mute, Aaron. less than half of our sellers. I'm sorry, I got that all messed up. Most of our sellers are looking for less than half of financing or earnout. They want at least a 50% down payment on their business. They're selling their business for cash. They've come to a broker. They're paying us at least $30,000. That's our minimum commission to sell their business to get cash. They're not paying website closers $30,000 to then do 100% financing and work for somebody. So this is extremely important, understanding the nature of the deal. Brokers should be, thoroughly vetting the buyers and understanding what their ability is to finance and close the deal is upfront. And you should not be looking at website closer deals unless you've got about $250,000 in cash at least, because you're going to need that to put down on a business. And occasionally you'll get a sweetheart deal that's an SBA or has some, really it's SBA or nothing. It's SBA or bust to get the bank financing. Small business loans, unless you get it with a collateralized line of credit on your house or on your own recurring business that has goodwill and cash flow in it, you're not going to get financing. So figure I would talk about that part, and then also the earnout. Earnout can be quite common. The bigger the deal and the less opportunity there is for financing if it's not an SBA financeable deal. I coach most of my sellers to expect that there's going to be a component of financing or earnout, and it may be up to about 50%. And again, that's where the seller has to decide what's it worth for them, and where do they want to go on that scale of 50 to 100%.
Right. Under 2.3, closing adjustment, purchase price shall be adjusted. Whenever you see the word shall in a legal document, it's really a big word. It means must. So you really want to be careful of shall whenever you get into a legal agreement. You have to, it's very, very important. So the purchase price must be adjusted as agreed by the party. So it's giving you some wiggle room, saying that it still has to be by mutual agreement, between the parties. But whenever you see must, the shall means must. So that's critical to understand that whenever you interpret a contract. So the purchase price shall be adjusted as agreed by the parties should any of the financials provided by the purchaser be found inconsistent during the due diligence, or should any concerns arise during due diligence. Now, in such case, the party shall have an opportunity to walk away from the transaction without liability. Now, it's very important, because even though you've got this closing adjustment that you're talking about, once you get into the asset purchase agreement, it will specifically say that the asset purchase agreement will supersede any prior negotiations or any prior oral statements or any prior documents, including the LOI. So this will actually go away. And what you're left with is whatever is defined in the asset purchase agreement. Now, but it's very important, because what you're saying in the general intent is we could find something that's off, and we're still going to resolve we're going to resolve any disagreement with inconsistencies by having a mutual agreement to address them and make any adjustments. So you're saying that things can't be perfect. You might come up with things, but rather than walk away, which you could, we have a general intent that we'd like to see if we can work it out.
Thanks for watching. If you liked this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.